When it comes to trading options, one tool that a trader can use is Trendlines. Now, Trendlines, they just represent the history of price movements in an asset, and they can also be used to identify support and resistance levels, as well as predict potential future price zones. And they can also be used as a proxy to determine momentum in cases where prices are overextended. And by understanding how Trendlines work, traders can make more informed decisions, maximize returns when they're trading options. So we're going to take a look at what trend lines are, how they can be used, and some strategies for maximizing returns with options when you trade with trend lines. So what are they? Simple. Trend lines are just angled lines that connect two or more points on a chart. Now, these points represent the high and the low of past price over a certain period. Now, trend lines can also be converted into channels that show if there's a change in the rhythm of price movements. Now, in options, depending on your strategy, you either want to see strong directional moves or even cases of range-bound instruments, depends on your strategy. Trend lines are also used to identify key support resistance levels, potential support resistance levels, because you never know if they're going to hold or not. And these are areas where prices may stop going up or down, respectively. Now, a support level is when the market finds it difficult to move below a certain price point, while resistance occurs when the market cannot break through a certain price level. When you understand these levels, they allow traders to better plan their trades by looking for entry or exit points near these areas. So in this image, the solid lines are drawn first when we have two lows that we can connect to. The dashed lines are placed at the swing high between those 2 points. Now, if a new high does get made, you can just drag that dashed line to the new high to reflect the new reality. Now, if that bottom line begins to cut through price, got to redraw them to avoid that happening. Remember, these are areas, not precise price points, so you will get some splash around these levels. Now, we can use them to make trading decisions by providing insight into potential profits for an options trade. So, for example, if there's an uptrend in the price of the asset, then you might buy calls on that asset with the expectation of higher prices. And prices will generally rise until an overhead supply level is reached, resistance areas. At the same time, if you spot a downtrend, you might want to buy puts on that asset since its price should continue falling until it hits support. So there's this phenomenon in price movement called measured moves. And this is where one move in an instrument is close to or equal to a previous move. It's nothing magic here, except prices are going to move with similar volatility until some market moving news hits the wire. So this is why you're going to see prices trade inside a channel for a time before they explode in one direction or another. Something happened. Now, at NetPicks, we do use basic calls and puts at times, but we usually go to vertical spreads for our trading. Now, using trend lines can help an options trader who's expecting a directional move to know when it may be time to exit the trade. How we do that. So when you use trend lines, you can use different strategies. Simple buying calls and puts based on expected direction changes in the market. You can write covered calls and puts based on expected trends continuing in their current direction. You can use straddle trades. It's a whole bunch of different things you can do. Now, time matters with options trading. When you sit in a position during a retracement of price, depending on the strategy, that can be devastating to your position. When you use trend lines, and more specifically trend channels, you now have a probable area where price may stall or, worse, move against you. So this chart here is Intel, and it's in a downtrend. It's been going on since April of 21. On a recent rally, price puts in a high at number 1. Price ranges for a little bit, finds a low at number 2. But now we need a swing high to connect to number 1, and we get that at number 3. We can then clone that line and attach it to the low at 2. So imagine that you're looking to buy a put option when price returns to the upper trend line. So when price returns to the area of the upper trend line, you buy a put option and you choose the strike price where the high of number 5 is made, and that's $30. Now at NetPicks, we teach our traders to look at buying contracts that are 1 or 2 strikes in the money with expiration dates about 20 to 60 days out. Now if that VIX is above 15, which it was on the day that this high was made, we can look at shorter term weekly options with 7 to 20 days to expiration. So our risk on these trades is whatever it's going to cost us to set it up. So as an example, buying one $30 put was $3.30. The maximum risk we have is $3.30 per share or $330 per contract. Now the premium is going to be impacted by your expiration date. The further out you go, it's going to be a bit more expensive because the underlying will have more time to make a directional move. Near-term expiration dates are cheaper, but they do come with less time value. Now, the benefits of using these trend lines or the channels is our entry price and our targets, they're set. In our example, we want to manage or close the trade at the lower trend line, which was $27. Now, note the channel did break, but there was not a whole lot of price movement afterwards, and time decay begins to add up when price stalls. So the issue with buying calls and puts is you need that directional move to occur quickly, and you really don't want to sit through any sideways action. Our profit potential is pretty good on this trade, as theoretically stocks can go to zero. Our risk is defined by the cost of the trade, but we do need a directional move quite quickly. We can use a vertical spread. So if I'm bearish, buying a put option, we can do that one way. It is more expensive. Using a vertical spread is another way, and it's cheaper, but it does come with some limited profit potential. So let's pretend you want to short MU and you use the trend line technique we've been talking about. Price gapped up to the upper trend line and you want to take a short. So at the time of the screen capture, a $53 put was $2.54. Remember, you are bearish, and perhaps you want to lower your cost for the trade while still having a defined risk. Now, just wanting you to note, these are not actual trades that we would necessarily take. There's other things to go into it. These are just examples of using trend lines. So we enter a long vertical put spread. So to set it up, we would buy one put, we would sell another put. So we buy one 53 put, and that costs us $2.55. But we also sell a 45 put, and that gives us a credit of 44 cents. So the total cost is $2.09. That's using the bid examples from this broker. So our profit potential on this trade is limited to the difference between the long and the short strike of $8 minus to put the cost of the trade on, which was $2.09. Our profit potential is $591. The maximum risk is what we paid for the trade, $209. Our break-even price is a long strike of $53 minus the cost of the trade, gives us $50.91. So by using this vertical spread, we actually reduce the cost of the trade from $254 all the way to $209. So in a perfect scenario, the stock's going to come close to the lower trend line, which is our short strike price of 45 bucks. So quick facts here. Number one, using trend lines and channels, they can help you define entry and target prices. 2, put options can be bought when the price returns to the area of the upper trend line. 3, vertical spreads, our favorite, they can be used to reduce cost and you still have a defined risk. 4, the maximum risk is limited to whatever we paid for in the trade. 5, the opposite side of the channel is your take action zone. So by using trend lines, we can set up entry and exit points. We can buy puts or calls, and that's one way to do it, but there are other things to look at out there. But in either case, traders need to ensure that they're aware of the risks that are associated with trading and the strategies that they're using. And if you're looking to get started trading options, Dynamic Duo has your back. And it's a downloadable guide. It's totally free. Has all the information you're going to need to look at trading 2 highly successful markets and potentially see some serious profits. Plus, it's a one-day options trading strategy. It offers even more potential for success. Don't wait. Just download it now and you can start trading it today. Even better, think about dropping our options specialist, Mike, an email to find out more about our overnight pop trades. There's his email right there, Mike@netpicks.com. Thanks for watching.